Good morning, everyone. Welcome to this rundown for global stock markets for the 12th of April. And as the title indicates, April is typically a pretty strong month, and it certainly started out quite well. You may recall there was a sudden 300-point fall in the Dow about 2 weeks ago, but that hasn't really gone on any further, as we've seen so often over the last couple of years. And it appears as though the market is just going to continue to grind higher and probably set a new high in the near future. But look, there are some interesting changes, which is what I want to talk about in this edition. So let's have a quick look at what happened last week. The S&P 500 ended up 35 points on the week and managed to close just above 2,100 points again. So the index overall is still trending up. There's been no change there. But it's quite clear now that so far this calendar year, the American stock market is not the global leader anymore. Money is definitely moving offshore. There are several reasons for it. Some of it is factual and some of it is perception, as is always the case with the stock market. We're seeing the strong US dollar is having an impact on corporate profits, the companies that have got global businesses. So there's no question there is some impact, but it's nowhere near as big as what is being factored in. And the expectations for the current earnings season, which started last Wednesday, are exceedingly low. They've absolutely fallen off a cliff since December 31. And I think the market's just being too conservative about that. So I think we'll see some earnings surprises to the upside. I mean, companies that will show any sort of profit growth at all will basically move to the upside because they'll be beating expectations. Funds are clearly flowing into Europe. There's no question about that if you look at the data. There is some liquidation of American stocks, and some of the large American fund managers are moving their funds into Europe. However, and I need to make this point really, really clear, targeted sectors in the US are still likely to outperform most other places around the world for a considerable period of time. So when I say that the US market is underperforming, I'm talking at the broad index level. But in the particular sectors in which I operate, I think the prospects still look terrific. But nevertheless, there are opportunities elsewhere. So just to underscore, here's a couple of charts. This is from January to the current this year. The black line is the is the Euro Stoxx 50. So that's predominantly German, French, Dutch, and there is a Spanish major company in there as well. So that's the top 50 stocks in Europe, is the black line. And the blue line is the Dow Jones Industrial. So you can see this year that clearly Europe is outperforming America. Let's have a look at America versus emerging markets in general. So this is a basket of emerging markets, which includes some of the South American companies, includes China, includes Russia, includes India. So there's a whole raft of different ones in there. So it's outperforming it by a reasonable margin. 9%, it's up 9% this year, emerging markets, compared to the S&P 500, which is the blue line, is only up 1.6. So that's a massive outperformance. Now, some of those emerging markets are extremely dangerous, and some of them represent terrific value and terrific opportunities. And as members of special share education know, we've already started making a move into at least one of those markets, which I believe is attractively valued and offers good upside. And we're doing okay with that position. So let's have a look. We'll just have a look at the details on the Australian market, and then we'll go and look at some other charts. The ASX 200 ended up by 70 points on the week, so it was quite a positive week for 4 days. And our index is outperforming the American market. But again, as I've been saying for a long time now, it's doing it on very poor value. The stocks in Australia that are offering yields in excess of 4%, extremely attractive to overseas fund managers. They don't care about value. They're just after the dividend return. but that doesn't make them value, and it doesn't make them less dangerous. So I see the Australian market as being potentially quite a dangerous situation. If there is a change in sentiment, then and money does start to pull back out of Australia, then we're going to see some extremely sharp falls because there's certainly no value there. So my recommendation continues to be, if you want to get reliable results, and that's what any trader or investor should be after. It's not about trying to shoot the lights out and get the best return you possibly can. It's about getting a good solid return, but doing it consistently year in, year out. So if you want to get the most reliable results, then you've got to wait for value, and you must have some sort of technical buying advantage. And the reality is it's just extremely difficult to find either of those things in the Australian market. It doesn't mean the market can't keep going up, but I'd rather much prefer to fish where I know there's much better value. So let's have a look at some charts. This is the S&P 500 on a daily chart first of all, so you can see that there's really been no change at all in the trend. It's perhaps just flattening out just a little bit as some money goes offshore, but there's really no change there at all. And if we look at the monthly chart, sorry, that's not the monthly chart, that's the monthly chart. On the S&P 500, you can see it just remains in a very powerful uptrend. It's overbought, but let's see how it continues to perform. Just having a look at China quickly. The Chinese stock market is in a bubble. In my view, money is not pouring into property anymore, and it's going into the stock market. There are a lot of Chinese companies that are trading on PE multiples in excess of 100. I think that's just a ridiculous market, so I wouldn't touch it. But the fact is it's still going up, and people are still ploughing money into it. Now, just looking at the ASX 200, as you know, I don't place much emphasis on this index. I think it doesn't really tell you very much that you don't find out just by looking at the bank charts. So you can see it's been in consolidation now since around about mid-February. Hasn't really done very much. It's just dancing around between 57.50 and 6,000. I guess the way things are looking at the moment, it may eventually break 6,000 points, but it's not going to do it with my money attached, that's for sure. Now, moving on to commodities, gold was flat on the week. There's still no definitive move in gold stocks, and for that to happen, one of two things needs to occur. The US dollar needs to stop going up, so it needs to change trend and turn over, and it's very hard to see from a fundamental point of view that that would happen. I just can't see the circumstances. That it would require the ECB to stop stimulating, and I think that's almost incredibly unlikely to happen. Or the other alternative is we need to get some serious fear about the financial system falling apart. And again, it's hard to see the circumstances where something serious would come up. Yes, there could be some short-term issues to do with the Middle East, or a couple of other areas, but there just doesn't really seem to be any reason for real fear about the financial system itself. Copper was steady. We'll have a look at the gold chart in just a minute. Copper was steady at $2.75, and it's just really tracking the US dollar over the last few weeks. Crude oil has firmed up a little bit, got down into the low 40s. It's back up to the low 50s. There is strong resistance at $55 if you think back to the charts that I put up a week or two ago. So there's definitely strong resistance at 55, and I think this move that we're seeing at the moment is just a bit of short covering. Hedge funds that were short, heavily short oil, are taking some profit just in case, and that's caused the price of oil to go up. But the fundamentals really indicate a significantly lower price yet, and particularly if they strike a deal with Iran, and which could put another 1 or 2 million barrels a day into the oil market around the middle of the year, then I've seen some projections for oil down in the $20 range. The bottoming phase typically takes 1 to 3 months. Doesn't mean that that will happen this time, because I think the circumstances are a bit different this time. We've got such a higher amount of supply coming out of America. But I don't think we've seen the bottom in oil yet, because supply and demand is still substantially out of balance. There's the chart on spot copper. We'll just have a quick look at gold. So there's the gold chart, first of all, on a weekly, so you can see it's still just continuing to sit around this 1200 mark. And if we look on the daily, we had a little bit of a positive move on Friday night, but really it's just up and down every few days. So just to wrap things up, overall, I really see at a big picture level over the next year, 18 months certainly, I see stocks being in what I would describe as an ideal environment. Now, it doesn't necessarily mean that it's good value, but an ideal environment in the sense that it looks highly likely that interest rates are going to remain at almost zero for quite a period of time. It looks highly likely that Japan and Europe in particular will continue to stimulate massively, which that and the low interest rates just is forcing money into the stock market. And in America, I think corporate profits are running along okay, and their economy is good enough. It's probably slowing a little, but it's good enough for stocks to continue to perform. So that's why I describe it as an ideal environment on a big picture level. April tends to be a strong month, and it started out fairly well, but May through August, September tends to be weaker, and if there are any valuation concerns that come to the fore, then certainly that'll be the time when markets could take a step back. Overall, I think the main indices around the world could be sideways until October, but I still expect great stocks to outperform. That's certainly what's happened, as members know, over the last couple of years. The good stocks have done extremely well. And I think diversification outside of Australia is an absolute given, in my opinion. But now it's not just America. That's the place to be. There are other places to look, and if anyone would like anyone who's not a member of Specialist Share Education would like some more information about what we do and about how to access these overseas markets, then please get in touch with me. That's it for this week. Cheers.